Last week ended on a high note for markets, thanks to some positive developments on the trade front between the US and China, along with better-than-expected US jobs data. The S&P 500 climbed 1.5% over the week, while the Nasdaq 100 rallied an impressive 2%. Despite a sharp sell-off in Tesla shares, sparked by a heated dispute between Donald Trump and Elon Musk, the Nasdaq closed just below its all-time high from February. Meanwhile, the S&P 500 hit and closed above the key psychological level of 6,000 for the first time since February. But as we approach overbought conditions, it's worth watching whether this momentum can hold. On the bond front, Friday's rally was driven by a narrative that the U.S. economy remains surprisingly resilient, even amid trade chaos and geopolitical uncertainty. The U.S. added 139,000 new non-farm jobs in May, while wage growth unexpectedly accelerated. This gave ammunition to Federal Reserve hawks arguing against a rate cut in July. For now, September looks like the earliest point at which the Fed might consider cutting rates, and even that depends heavily on inflation. On Wednesday, the U.S. will release its latest CPI data, and forecasts suggest growing price pressures in both headline and core metrics. If inflation continues to rise, it could further cool expectations for rate cuts. The U.S. two-year yield jumped past the 4% mark on Friday, signaling that the Fed is unlikely to act as a catalyst for equity bulls anytime soon. However, a strong auction of 30-year U.S. bonds on Thursday helped ease concerns at the long end of the yield curve, with the 30-year yield opening the week just below the 5% psychological level. Speaking of trade, there's more to unpack here. Chinese exports grew much slower than expected in May, weighed down by still elevated triple-digit import tariffs, while imports fell significantly more than forecast. Consumer prices in China declined for the fourth consecutive month, and producer prices continued to drop sharply. Despite these challenges, Chinese equities opened the week on a mildly positive note, supported by hopes for further stimulus from the People's Bank of China and the government. Additionally, the second round of U.S.-China trade talks, held today in London, could lead to further progress. Last week, a phone call between Trump and Xi yielded news that China would relax export controls on rare earth metals to the U.S., suggesting the U.S. may also ease restrictions on certain technology exports. Still, some observers warn that this round of talks may not bring the same level of progress as the first. Any lack of progress could prompt investors to take profits and move to the sidelines. In earnings news, all eyes will be on Oracle and Adobe this week. Oracle reports on Wednesday, and its results will provide an update on cloud infrastructure momentum. Last quarter, Oracle's infrastructure business grew an impressive 50%, driven by demand from major clients like NVIDIA and OpenAI. However, concerns linger about the multi-billion-dollar Stargate data center expansion and whether the company is spending too aggressively on AI, a move that has some investors uneasy. Meanwhile, Adobe reports on Thursday, offering insight into whether consumers are willing to pay for AI tools. These reports will be key indicators of how tech companies are navigating the rapidly evolving landscape of artificial intelligence. Over in Europe, growth data surprised to the upside last week, with Ireland and Germany leading the charge. The upside surprise was largely due to net trade, as exporters rushed to ship goods ahead of expected U.S. tariffs, a boost that may be temporary. Investment also rose in Q1, supported by increased government spending, particularly on security. The Stoxx 600 closed the week 0.9% higher, while the Eurozone remained bid below the 1.14 level, though it has yet to break through the 1.15 resistance. The European Central Bank delivered another 25 basis point rate cut but signaled that this may be the end of the rate-cutting cycle. Continued inflows into euro-denominated assets should help support the euro against the dollar. In Japan, GDP figures released earlier today showed stronger than expected growth and hotter than expected inflation. This reinforces expectations of a more hawkish stance from the Bank of Japan. The USP is currently testing its 50-day moving average to the downside. A break below this level could trigger further declines, with key support seen in the 142.50 to 142.75 zone. In the energy sector, U.S. crude rose more than 5% last week, boosted by optimism over U.S.-China trade progress, a weekly decline in U.S. inventories, and strong U.S. jobs data. Crude is consolidating just below the $65/barrel mark this morning. Any positive surprise on the trade front could lift prices above the $65.35 level, a key retracement of this year's decline and a potential signal of a shift from a bearish to a medium-term bullish trend. So, what's next? With trade talks underway, inflation data on the horizon, and earnings reports from key tech players, The coming weeks promise to be pivotal for global markets. Will the momentum continue, or will investors hit pause? Stay tuned, and don't forget to like, comment, and subscribe for more updates.